Hi everyone, 45 minutes to the FOMC tonight. I think it's pretty much a done deal that we're going to get no change. I've just gone through the math of the probabilities. So it looks like March, there's a 5% chance of a 25 basis point move tonight. You've got a few pundits, economists thinking that they will hike, and basically they are on their own. You don't start to get any real feeling from the markets of a hike until April. By June, actually, there is a good 60% chance of either another two hikes to come. So the market is a little bit ahead of itself tonight in terms of its pricing. If you think back a month ago in the treasuries and the Eurodollars and the Fed funds, there was basically a 10% chance of a hike for June and April and June. So that's moved substantially. Now, as you know, the Fed have basically said they're going to make three hikes in 2016. They've also followed that up by saying, well, if we don't go three times, because it's going to be data dependent, if we don't go three times in 2016, we'll do more in 2017. I mean, they're being very clear. I think the ambiguity around very data dependent is confusing the markets. I think the best barometer is to watch the equities, and which of course at the moment is looking at the commodities for signs of a pickup or a fall in inflation. So tonight we've had, if you look at the charts, what I've got here on the right hand side, I've got the 5-year, the 10-year, the S&P, and the dollar index on a 240-minute outrights. They're the outrights. And in the middle, I've got your 2s, 5s, 2s, 10s, 5s, 10s, and 5s, 30s US Treasury curves. And on the far left, I've got the front Euro-dollar spread. So the front year, June 16, June 17. Then the reds, June 17, June 18. Then the greens and the blues. So what you've got, like I say, about a month ago, we started to see a repricing of risk, and we started to see the market start and good data starting to come out of the US. And you can see that clearly in the charts. And interestingly, what you can see, if you focus on the middle chart, right, and then just looking right at the outrights, as you expect, as the outrights are coming off, the front end of the curve, 2s, 5s, 2s, 10s, is steepening up with that sell-off in the 5-year in the US and the rally in the equities. Interestingly, what happens with the back or the 5s, 10s, that belly of the curve, it steepened up at the beginning because it was unsure, is this just a repricing of a small repricing of risk? But once the market got serious about the Fed maybe looking at June again and April for hikes, the 5s, 10s curve started to peak, flatten off, and then it started to come off like its back month spreads in the 10s, 30s, which unfortunately I haven't got. You notice the back end Eurodollar, so June 18, June 19, June 19, June 20, they haven't rallied up with the 2s, 10s. And so what I take away from here is we've seen a repricing of risk. The Fed are probably going to be looking at two hikes through 2016. If you see some very dovish talk, expect to see a big move up in treasuries. Where would I expect to see that curve move? Well, you'd obviously expect to see the front of the curve flatten off. If the Fed, I can't see it because the data's been slightly better and we haven't had big stock routes in Asia. If that would happen, I would expect to see the back spreads steepen up. So if you're looking to buy these back spreads and sell the front spreads, June 16, June 17, and buy the back spreads, I think we're going to see status quo, right? We're not going to the concert, but what we're going to see is a status quo of what we've been seeing in the last few days. Maybe a relief rally. I think that's it. But good luck.